Well, as we mentioned at the top of today's program, Janet Yellen out over the weekend making some comments on her tolerance for higher inflation. We've certainly covered inflation at length on this program and will in the months ahead, Brian Sozzi, as we think about what it does or doesn't mean for the potential performance of the stock market.
Yeah, there's a lot of historical data here to consider. In the folks at Goldman Sachs, I always love me some Goldman Sachs research notes to kick off the week. And they went back to 1962 to see how the markets and stocks have performed during periods of high and low inflation. They note that the market's real return during high inflationary backdrops has been an annualized 9% versus 15% during periods of low inflation. So the quick takeaway there is stocks tend to do better during periods of low inflation. Perhaps no surprise there. Nonetheless, it's good to see in the numbers. They also note, which is interesting and perhaps very relevant to the discussion today on inflation, guys, the median monthly real return for the market has been 2% annualized when inflation was high and rising, compared to the 15% when inflation was high and falling. So if you are one to believe that inflation right now, it is high, yes, it is. You see that through many metrics, and you'll probably see it this week in the Michigan Sentiment Survey and the CPI, that is key inflation reads. If you believe it's high and falling, then perhaps stocks will have a good second half of the year. But also worth noting here, too, got also a good note from Deutsche Bank's Jim Reed. He writes a lot of these early market notes. He's noting that inflation it is a scary thought that just as inflation is being deprioritized, fiscal and monetary policy is being coordinated in ways that the world has never seen. Meanwhile, COVID has created a tremendous war chest of excess savings. What Reed and his team at Deutsche Bank are essentially saying is that inflation will likely remain a problem not only for the back half of this year, but into 2022. And perhaps investors should be paying a little bit more attention to it than they are now. A lot of inflation fears in the market have receded over the past month and a half. And guys, here's my quick take. Be worried about inflation. It will impact your portfolio in 2021, 2022. It may not impact the meme stocks you're trading right now, but it will likely have some form of impact. You probably want to favor dividend stocks in this inflationary backdrop. You look at a lot of dividend ETFs. They have come on strong over the past 2 months. Again, as inflation readings have picked up, dividend stocks obviously pay a dividend, so they help you offset inflationary impacts. And then last but not least, be open to allocating cash to crypto, especially against this pullback. If the dollar is going to get attacked by higher periods of inflation, perhaps crypto is worth a small portion of your portfolio.
Who are you and what have you done with Brian Sozzi? Are you sure that number 3 is that's very unfamiliar for Soz for you to say something like that?
One of the biggest tickets to success is evolving and rolling with the punches. That is what I'm doing live right now in real time.
Just a quick question, Brian. In that Goldman research in particular, how far back were they looking at those sort of high inflation, low inflation periods? Because if they're looking at the 80s, for example, to sort of compare that level of inflation stock performance then with this level of inflation doesn't really seem comparable.
Goldman went back to 1962, and a lot of the calculations they did were pre-1980 and then after 1980. But again, almost 60 years worth of data here that the Goldman Sachs folks, led by David Kostin, the chief U.S. equity strategist, they crunched.
I just see stocks up 9% or 15%. So I'm really not seeing the issue here with sort of this whole where you're putting your cash, all that nonsense.
To your point, like you've always said, Myles, stocks usually go up. But I will note that what stocks go up will matter more. It will change during periods of high inflation because of fears of higher rates. Goldman noting that tech will probably underperform in this environment. We've seen that in many respects this year.
Yeah, I mean, I would say this though as a reminder to, I don't know if a reminder is the right word, but just like this is how these things go. We're sitting here in June as we await a really hot inflation print, talking about how inflation might impact stocks. But if you look at what's happened in the last 9 months of the stock market, all the stocks that are exposed to higher inflation have already ripped. So the trade has happened by the time we're discussing it. And I think that is the challenge of saying, well, now that X is happening, it's time to do Y in the portfolio, because really it's before X happens, it might be time to do Y. But if, like most people, you have a day job and you're trying to save for retirement, you're not on top of that trend, nor should you be. You're living your own life, and there's only a few number of pros who are actually going to get that trade right. So again, Hence my
Or you can just buy the
conservative
SPYs and forget about it, right? Just buy
AMC.
Exactly. You don't have to be smarter than the market. You can just get the market return, and you can also get it basically for free.